Tyler is 29 years old. He works as a warehouse supervisor in Columbus, Ohio, makes $52,000 a year, and has banked at the same national bank since he was 17, back when his mom took him in to open his first checking account. Last year, Tyler paid $180 in monthly maintenance fees. He paid $105 in overdraft charges across 3 incidents, all of them for amounts under $40. His savings account, which held $3,200 for most of the year, earned him $1.60 in interest. Not $160. $1.60. Meanwhile, 30 miles away, a man named Greg banks at the exact same institution. Same logo on the building, same app on his phone, same customer service number. Greg paid $0 in monthly fees. When he overdrafted by accident in March, the bank called him not to charge him, but to waive it automatically before he even noticed. His savings account earned him $340 last year. Same bank. Same zip code, basically. 2 completely different financial universes. Tyler and Greg are not being served by different banks. They are being served by different tiers of the same bank, and nobody ever told either of them that the tiers exist. Are you sure you know which tier you're actually in? My name is Peak, and I spend way too much time pulling apart the invisible mechanics that decide who gets to keep their money and who slowly bleeds it out one fee at a time. If you've ever looked at your bank statement and felt like something didn't add up, or if you've ever wondered why your coworker with basically the same salary seems to pay nothing in fees while you pay something almost every month, make sure to hit that subscribe button, because today we're taking the entire banking system apart and showing you exactly which tier you've been placed in without your consent. Here's the thing most people get completely wrong about banking. They think of it as a utility. Water comes out of the tap the same way for everyone. Electricity flows through the wires the same way for everyone. So surely, people assume a checking account works the same way for everyone too. You put money in, you take money out, maybe you pay a small fee. That's just how banking works. That assumption is the single most expensive misunderstanding in personal finance, because banking was never built as a utility. It was built as a segmentation engine. Every major bank in this country quietly sorts its customers into tiers, usually 4 of them, and which tier you land in determines almost everything about your relationship with money for the rest of your life. Not because of who you are, because of a number. Let's lay out the 4 tiers, because once you see the structure, you cannot unsee it in your own statements. Tier 1 is what the industry internally calls the mass market segment. This is anyone with a checking account and no meaningful relationship balance, usually under $5,000 or $10,000 combined across accounts. If you're in Tier 1, you are the least profitable customer type for the bank on a per-account basis, and profitability isn't measured by how much money you deposit. It's measured by how much fee revenue you generate. Tier 1 customers are the primary source of that revenue. Monthly maintenance fees, overdraft charges, ATM fees outside the network, minimum balance penalties. This tier funds a shocking percentage of a retail bank's fee income, and the products offered to this tier are designed quietly and deliberately to produce fees rather than prevent them. Tier 2 is the mass affluent tier. This kicks in once your combined balances, checking, savings, sometimes retirement accounts held at the same institution, cross a threshold, usually somewhere between $20,000 and $50,000 depending on the bank. Cross that line and something remarkable happens. Fees that were previously unavoidable become automatically waived, not reduced. Waived in full, permanently, as long as you maintain the balance. Interest rates on savings products quietly improve. You get access to what's called relationship pricing, which is a real internal term banks use, meaning your rates and fees are calculated based on your total relationship with the bank, not the product in isolation. Tier 3 is private banking or premier banking, depending on the institution, and it usually starts somewhere between $100,000 and $250,000 in investable assets. At this tier, you are assigned an actual human being, a dedicated banker with a direct phone line who can override fees on the spot, expedite loan approvals, and proactively call you about better products instead of waiting for you to discover them yourself. Tier 4 is wealth management, typically $1 million and above, and at that level, the entire fee structure essentially disappears, replaced by an advisory relationship where the bank makes its money on assets under management rather than nickel and diming you on a checking account, because at that point, nickel and diming you would be beneath both of you. Here's the part that should genuinely unsettle you. These 4 tiers are not describing 4 different products. They are describing 4 different prices for identical banking. The checking account itself, the app, the debit card, the physical branch, all of it is the same. What changes is the fee schedule and the interest schedule layered on top of it based entirely on your balance. And this is where the math gets brutal, because the fee structure isn't just unfavorable to Tier 1 customers. It is actively regressive. It costs more, in real dollar terms, to be poor at this bank than to be anyone else. Let's run Tyler's actual numbers against Greg's, because the theory only matters once you see it in dollars. Tyler's monthly maintenance fee is $15, waived only if he maintains a minimum daily balance of $1,500, which he cannot reliably do because his paycheck gets deposited, immediately covers rent and bills, and the balance dips below the threshold for stretches of nearly every month. Over a year, that's $180 gone, not for any service, but simply for the crime of not having $1,500 idle dollars sitting untouched. Greg's identical account has the same $15 fee structure on paper, but Greg's combined balances sit comfortably above the Tier 2 threshold, so the fee is waived every single month without him lifting a finger. Same account, same bank, $180 difference, and it isn't performance-based or loyalty-based. It's balance-based. Now the overdraft fees. Tyler's 3 overdrafts last year cost him $35 each, $105 total, for transactions that were combined under $120 of actual overdrawn money. Run the annualized interest rate on that, and you're looking at something in the neighborhood of an 80 to 90% effective rate on short-term borrowing, charged automatically with no human review. Greg overdrafted once. His bank has an internal policy, never advertised, never disclosed in any pamphlet, that automatically waives a single overdraft per year for relationship customers above a certain balance threshold as a retention gesture. Tyler doesn't get a retention gesture. Tyler funds the retention gesture. And then there's the number that stings the most, the savings account. Tyler's $3,200 sat in a standard savings account earning an interest rate so close to zero it rounds to it, which is why his annual return was $1.60. Greg's balance sits in what the bank calls a relationship savings tier, unlocked automatically once his combined assets cross the threshold, earning a rate roughly 200 times higher than what Tyler receives on the exact same product name at the exact same bank. The bank isn't lying when it advertises competitive savings rates. It's just not advertising which customers actually receive them. Add it up, and Tyler is out somewhere north of $400 a year in fees and foregone interest, compared to Greg, for functionally identical banking behavior. $400 might not sound catastrophic in isolation, but remember, this is the same trap as every poverty premium we've talked about on this channel before. It isn't one big loss. It's a permanent, compounding, invisible tax that never shows up as a single alarming charge, so nobody ever gets angry enough to question it. So why doesn't anyone question it? This is where we have to talk about the psychology, because the tier system only works if the people inside Tier 1 never realize a tier system exists. Behavioral researchers who study financial decision-making have documented something called the invisibility of relative pricing. When a fee is charged uniformly and consistently, your brain files it under the category of normal, unavoidable, just how banking works, rather than the category of a price you are specifically being charged because of your balance. Tyler saw a sign at his bank that said, "Customers under $1,500 pay $180 more per year than customers above it." He would be furious, and he might actually move his money. But that sign doesn't exist. Instead, the fee arrives quietly on page 3 of a monthly statement most people don't read, described in language engineered to sound like standard policy rather than a penalty for being broke. There's a second mechanism working alongside it, something researchers call the switching cost illusion. Moving banks feels like an enormous undertaking, updating direct deposit, changing autopay, closing an old account, even though in practice it usually takes less than an hour of actual effort spread across a week. Banks know this. The perceived hassle of switching is dramatically larger than the actual hassle, and that gap is where they make their money. They are not competing to win you as a customer. They are relying on the fact that you will never leave, so the fee structure doesn't need to be fair. It only needs to be tolerable enough that you never bother to check what tolerable is actually costing you. Here's where it gets genuinely infuriating, though, because the tier system isn't static, and it isn't reserved for people who already have money. It's reserved for people who know the threshold exists. Most banks will move you into Tier 2 the moment your combined balances cross the line, whether that money came from a decade of careful saving or from consolidating 3 scattered accounts you already had into one. The tier isn't rewarding wealth. It's rewarding consolidation and awareness. Tyler doesn't have less money than Greg because he's worse with money. Tyler has his money spread across a checking account, a separate savings account at a different bank he opened for a promotional bonus 5 years ago, and $40 sitting in an old employer's 401k he forgot to roll over. If Tyler consolidated everything into one relationship, he might already be sitting above the Tier 2 threshold without earning a single additional dollar. He is paying the Tier 1 penalty simply because his existing money is scattered and invisible to the one institution that's deciding how to price him. This is the actionable part, because I don't want you walking away from this video just angry. I want you walking away with a specific plan. First, call your bank, not the branch, the actual customer relationship line, and ask a direct question. What is your relationship banking threshold, and what do I need to combine to qualify? Most banks will tell you immediately, because internally, this is not a secret. It's a sales conversation they're happy to have. They just never initiate it with Tier 1 customers. Second, calculate your actual combined balance across every account you hold at that institution. Checking, savings, CDs, even a small retirement account if it's held there, because most relationship tiers count the sum, not any single account. Third, if you're close to a threshold, and closer than you think, consider whether consolidating outside accounts into that one relationship gets you there faster than saving from scratch would. Fourth, and this is the option most people skip entirely, if your bank's threshold is unreasonably high. Credit unions frequently offer relationship tier pricing, free checking, better savings rates, waived overdraft fees to every single member, regardless of balance, because their structure isn't built on fee extraction from a Tier 1 segment in the first place. Sometimes the fastest way to jump from Tier 1 to Tier 2 isn't earning more money. It's leaving an institution that was never going to move you there at all. The uncomfortable truth underneath all of this is that the banking system was never designed around the question of what do people need. It was designed around the question of how do we price risk and effort, and being poor, or even just being disorganized with modest money, reads to that system as both. You are being charged, quietly and continuously, for the crime of not yet having enough to make the fee structure bend in your direction. But once you understand that the tiers exist, that the threshold is a real, specific, discoverable number, and not some vague reward for being wealthy, the whole system stops feeling like fate and starts feeling like a puzzle with an actual solution. Tyler didn't need to double his salary to become Greg. He needed to find out where the line was drawn and then walk his money across it. If this video made you want to go check your own bank's relationship threshold tonight, do it, then come back and tell me what tier you actually landed in, because I guarantee most of you have no idea, and the number might surprise you in either direction. Share this with the one friend you know is still paying a monthly maintenance fee without questioning why. We don't talk about this stuff enough. We talk about investing, about side hustles, about the big wins, but almost nobody talks about the quiet tax sitting inside the account you've had since you were 17. Hit that subscribe button, because we're going to keep finding these hidden tiers until nobody's paying a fee they didn't have to. Thanks for watching, and I'll see you in the next one.